delve into the word control as much as we can. We will also talk about custodial funds and how the conversion to GASB 84 regarding agency funds is not that simple. We'll then also present some guidance on what we're seeing from governments that are working on or that have implemented GASB 84 so far. Finally, we'll wrap up with some of your questions if we have time. As a reminder, you can always email or call us with your questions, and certainly we encourage you to do that. So, GASB 84, it's really hard to understand, so let's just get that out of the way first. So today we're going to walk a little bit before we run. You may have heard this before, but as one of my colleagues used to say, 10 times for the normal mind, 100 times under stress. And GASB 84, it's one of those stressful standards that GASB has issued. The initial step in deciding if an existing component unit relationship is fiduciary in nature is one of the first things you have to think about. Again, is there an existing component unit relationship that is fiduciary in nature? Is there some component unit that might be fiduciary? It's a different way to say it. These can be pension or OPEB plans, both defined benefit and in certain circumstances defined contribution. Existing investment pool, existing external investment pools, college and university foundations, and many others. There may be pension and OPEB arrangements that are not component units that are fiduciary activities. And then there are fiduciary activities out there that are private purpose trusts and agency funds under GAAP prior to 84. All of these activities will need to be reviewed as part of the implementation process. There are 4 steps of many that get governments started down the road of GASB 84 implementation. Again, the first thing to remember about fiduciary component units is there needs to be a component unit relationship to begin with. Without a component unit relationship, then you skip down to step number 3. If there is a component unit relationship, then is that relationship for pensions and OPEB, or not pensions and OPEB, but perhaps for an external investment pool? Those are steps 1 and 2. Lee, what do you think? What are you seeing in practice in terms of component unit relationships that are pensions, OPEB, and so on?
Well, you know, with the number 1 square there, you know, a lot of things that ones that we see pretty straightforward are your state PERS plans. You know, they're fiduciary activities. They are considered component units, and if you were to go to a state CAFR, you'll find those, you know, typically in the fiduciary activities section of your financial statements. You know, from a local perspective, it would be if you were a single employer benefit plan. Again, set up it as a separate trust. It's considered a separate entity and everything, but again, it would meet all the criteria and it would be in your fiduciary activity. So that's typically what you'll see for, you know, for that number 1. For number 2, you know, it could be a health trust that is regulated by the State Department, and that health trust is, you know, it could be for, we've seen them with higher educations, we've seen them for cities and counties and everything, where it may not be a component unit, but it is providing a post-employment benefit at part of that health trust, and so therefore it would be, well, excuse me, I said something wrong there. They are a component unit, but, you know, they have a fiduciary activities, but it is for post-employment or along those lines. And so those are the typical things we see for number 1 and number 2.
That's a bunch of good stuff. I mean, certainly, you know, you have to be careful about whether or not there is a component unit in place, and you know, if indeed there's a post-employment benefit arrangement. I mean, I've gotten questions on, gee, well, is a flexible spending account a post-employment benefit arrangement that's a component unit? And And the answer is usually no. First of all, it's not flexible spending accounts are not post-employment benefit arrangements. They're for current employment. And second, it's pretty darn rare that those things be a component unit, because usually you're dealing with, a bank or some insurance company that's running a flexible spending account, but certainly not it's not a component unit, or in some cases, it's not even legally separate. It's just being run by the HR department. And so just understanding the differences, between a component unit and not a component unit, it's almost, step 1A. And that's one reason why we had the webinar a couple of weeks ago discussing component unit relationships, is we knew that there was going to be a lot of scratching of one's head in terms of the legal separation and so on. So moving on to, thank you, Lee. So moving on to step 3, is there, it's determining if there's a pension or OPEB arrangement that's not a component unit. And we'll talk about this in a bit, because some of that may be changing. Step 4, are there potential fiduciary activities under GAAP prior to GASB 84 that would become fiduciary activities, such as external investment pools, private purpose trusts, agency funds? By program, we know that investment pools may include things like local government investment pools at states, county investment pools for separate entities within a county that are not part of the county's reporting entity, and various savings trusts. For private purpose trusts, don't forget prisoner commissary funds and potentially college savings plans. Prior to GASB 84, agency funds included a lot of different activities, such as intergovernmental payments, child support disbursement funds, payroll clearing accounts and withholding, contractor check clearing accounts, and a lot of zero balance accounts. All of those will need to be analyzed, but we didn't even scratch the surface on perhaps the biggest issue so far, which is student activity funds. Now, this slide and the next slide get you thinking about GASB 84's 4 potential paths and common examples of each. Remember, there may be a multitude of other potential activities out there that may need to be analyzed. And Lee mentioned path number 1, which is pretty low-hanging fruit. Is there a component unit that is providing post-employment benefit arrangements? And a statewide PERS plan is a classic example of that. And to the best of my knowledge, those relationships between states and component units already in existence that are fiduciary in general aren't going to be changing. Is there path 2, is there a component unit that does not provide post-employment benefits arrangements but is a fiduciary? And I have an example down here of a foundation of an institution of higher education, but certainly an investment trust, such as an external investment pool that is again run by either state or counties, would be an example of number 2 if it is indeed a component unit relationship. Number 3, are there post-employment benefit arrangements that are not component units? And as Lee mentioned, a single employer plan, and in many cases, those might not be irrevocable trusts. And since they're not irrevocable trusts, they're currently reported prior to GASB 84 in an agency fund, and those will need to be analyzed. Another one we're seeing a lot in practice is the various multitude of flavors of defined contribution plans that are out there. And stay tuned for defined contribution plans, because we have some news for you. The 4th path is, again, are there any other fiduciary activities such as investment trusts, endowments, and so on, those activities that are currently agency funds? And some of those could be fiduciary activities, others might not be, maybe, could be, might be. Notice that I'm using a lot of modifiers, and because every situation is different. And hopefully by now you may have seen a number of these presentations, And you may be realizing, oh, this is one of those standards that I can't copy off of my peer government and say I'm implemented. You really got to analyze it. And so again, the first step is whether or not you have a component unit relationship. So let's start there. We talked about this during our last webinar a few weeks ago, and I'm resurrecting the same slide because, again, 10 times for the normal mind, 100 times under stress. So to have a component unit, there needs to be legal separation and accountability. Without those two aspects, there's no possibility of a component unit. So let's say we do have legal separation. Then there are two paths with a decision point at whether or not there is a voting majority. If yes, then the next decision is there some form of financial benefit or burden, or is there an imposition of will? Now that word "or" is really important. Come back to that in a bit. But if the answer is no, then you don't have a component unit relationship. If there was not a voting majority, then is there some form of fiscal dependency and financial benefit or burden? Now, on the right side, you have to look at the word "and" because you have to have both. You need both. If not, then there is not a component unit relationship. If there is a yes answer to either branch, we're at a component unit, and then we need to figure out if it's a component unit that is fiduciary in nature or not. So we haven't even hit GASB 84 yet. We're still back at GASB 14, 39, 61, 90, and so on. And so take a look at these branches and remember them. So we've decided that there's a component unit relationship that could be a fiduciary component unit, but we must go a step further. Many practitioners skip this, even though there is a component unit relationship, because they're automatically assuming that it's fiduciary, but you have to go a little further. In general, and not always, if an irrevocable trust is in place for pensions and OPEB, they are legally separate. But that does not always mean that it's a fiduciary component unit relationship, especially without a defined benefit plan. There is a financial burden if the primary government is legally obligated or otherwise assume the obligation to contribute to those plans. Now, I have to remind you on what the word trust means. What it means to have irrevocable trust, and even the word is hard to say. As my friend GASB project manager Lisa Parker calls it, you need to have IDP to be a trust, not ADP, although you can say ADP for the word assets. The first letter I is for irrevocable, meaning you can't take funds out of the trust except for paying plan benefits. D is for dedicated benefits, and pretty much I just mentioned that. And P is for protection from creditors. In a more succinct fashion, the contributions must be irrevocable. Again, you can't take contributions out other than to pay benefits or pay plan expenses in accordance with the plan document, or perhaps provide loans depending on the type of plan, but all of that is established in the plan documents. The assets must be dedicated to provide benefits. And this is straight out of the IRS's exclusive benefit rule, which is in Internal Revenue Code section 401A2. That rule is absolutely key. It requires that a qualified plan be maintained for the exclusive benefit of employees or their beneficiaries, and that under the trust agreement, it be impossible at any time prior to the satisfaction of any liabilities in the plan for any part of the principal or income or trust be diverted for any other purpose. The paying of administrative costs to manage those benefits also fall under that rule. The assets, the assets must be legally protected from creditors, meaning in a divorce situation, bankruptcy, legal trouble for the government or the beneficiary, The assets can only be used to pay for benefits. In a divorce situation, a qualified domestic relations order or QDRO from a judge is allowable, and that doesn't mess around with the irrevocability of the trust. But without all three, there's no irrevocable trust. I mentioned a few minutes ago that not all pension and OPEB arrangements are component units, and some may not even be fiduciary activities. The first decision beyond legal separation and determining a component unit a few slides back was whether there was a voting majority. But plenty of pension and OPEB plans do not have a governing board. In some cases, the government is legally obligated to make contributions to the plan. But what about no governing board? In practice, in many cases, the board of a defined benefit plan adjourns. And then a few minutes later, a subset of the board or the entire board returns and becomes the governing board of a deferred compensation or a defined contribution arrangement. Now, some of these could be fiduciary component units, including component units that are either defined benefit or defined contribution plans. But current GAAP describes a 457B plan, which is very common in state and local governments, as a deferred compensation plan. It's not a pension plan. Again, 457B plans are deferred compensation plans, not a pension plan. And that's one of the sticky points that even I had delving into GASB 84. We tend to gloss over that little nuance. However, GASB proposed last year to adjust that if a 457B plan meets the definition of a pension plan in accordance with GASB 67, and of course it being a defined contribution plan, then it is reported as a pension plan. Prior to GASB 84, this aspect did not matter whatsoever. But there are many other pension and OPEB arrangements that are out there than classic defined benefit situations. For example, governmental 401k plans exist, especially for tribal governments and certain other regional or other educational entities that established the plans prior to the 1986 Tax Act. Are these fiduciary activities? Well, they might be. They might not be. So, Lee, what do you think? Some other stuff that we're seeing out there that could be borderline on, as to whether or not they're fiduciary activities, and especially these other arrangements that are out there.
We really haven't been seeing anything unusual, but I think what we're seeing is the type of entities that are actually going to have to address this situation. I mean, not only is it tribal governments, I mean, it's pretty straightforward, but you've got your higher ed, a government university, but more run like a for-profit perspective. And so they'll have your 403Bs and your 401Ks or whatever the different types of plans that are out there. Convention centers, or even some of the sports stadiums that are owned and run by governments. I think the football stadium for the Arizona Cardinals are run by a governmental entity. And in light of the fact that it's spring training and everything, and a number of the state baseball stadiums down in Arizona are owned by governmental, the cities or whatever, or a separate entity that have these types of plans, because they're all thinking themselves as for-profit entities, and they run accordingly and they're providing it for their for their employees. And so whereas before we just didn't really think about it, now it's really coming to the forefront and on everybody's radar screen that it is something that needs to be considered. The hard thing is it's not clear, and it's going to be hard to figure out, well, should or should they not be included?
Yeah, and certainly, that's going to be a real sticky point, Lee. And you mentioned stadiums and convention centers, and especially stadiums and convention centers, and I've had clients in my career which were both of those, and they happen to have 401k plans that were out there, and in many situations, You know, some of those plans are going to be fiduciary activities and others are not going to be fiduciary activities. It really depends on the facts and circumstances that are out there. And some of them might not even be legally separate. There's a real analysis that's going to have to go on. So have some breaking news for you. 48 hours from now, literally 48 hours from now, on March 5th, the GASB is having a teleconference to approve the re-release of the 457B exposure draft. In it, paragraph 7 of GASB 84 will be proposed to be limited to only defined benefit and OPEB plans that are held in trust or equivalent arrangements. Even though many defined contribution plans are held in trust and are legally separate, the determination of a financial burden it would be only for a defined benefit pension or OPEB plans to decide if a plan is a component unit that is fiduciary in nature. The remainder of the exposure draft will deal exclusively with 457B plans that meet the definition of a pension plan. So what is the definition of a pension plan? The exposure draft is going to refer back to GASB 67, which has a definition of a pension plan in it, which says a pension plan includes arrangements through which pensions are determined, assets dedicated for pensions are accumulated and managed, and benefits are paid as they come due. They can be defined benefit, or in this case, defined contribution. So if the plan meets this definition, then it is a fiduciary activity in the financial statements of the primary government or in standalone financial statements. If the plan does not meet this definition, it is not a fiduciary activity. The only flows would be outflows from employee withholding. It's just deferred compensation. Now, before all of you start heading for the exits, the proposed changes would be effective for fiscal years beginning after June 15th, but the year is a little bit in flux. Now, a staff paper said 2021, but they may be changing that until 2020. Question 4.6 on defined contribution plans in the GASB 84 implementation guide would be proposed to be rescinded. Early application may occur, as for many plans, the reporting may be different and potentially for the better. The GASB is going to be asking for feedback in about 30 days, April 10th. Now, there may be stakeholders out there who are for this and some who are against this, so stay tuned. But the GASB may be finalized by June 30th. A word of caution, these provisions and even the date could very well change. More than one question could be delayed due to this, and in some quarters, we're hearing as many as 3 implementation guide questions may be delayed or rescinded. Until we see things in print finalized with the ink dry by the GASB, all bets are off. And I'm sure the GASB knows that the timing puts everyone in a bind, especially the December 31st governments that are out there. And I'm also sure that the GASB wants to get it right. So just beware that this is out there. And what you may have to do is analyze the other provisions in GASB 84 if you happen to have one of these plans. So what about all other defined contribution pension or OPEB plans? I mentioned grandfathered 401k plans, but there are other situations where there are plans that may be fiduciary and some may not. We're talking about money purchase plans, retiree health accounts, not flexible spending accounts, as I mentioned before, 403B plans, and many others. Many 401A plans have mandatory employer contributions, and in some cases involve pickups where the employer steps in the shoes of the employee and pays both the employer's and the employee's contributions. Now, those are required to be held in irrevocable trusts, or they're not qualified by the IRS. So if there are these mandatory contributions out there, there is likely a fiduciary activity. For other defined contribution plans, pension and healthcare, these may or may not have employer contributions. If they're all the employee's money with no contributions from the employer, guess what, folks? Chances are those plans might not be a fiduciary activity. The only time they would be a fiduciary activity would be if the employer has control over the assets. We'll talk about control over in a bit, but there are varying degrees of control, and facts and circumstances may be different. And so I caution you in thinking about the word control. So remember that, and we're still talking about component units. The first decision point for a component unit was a voting majority. And voting majorities only need to be simple majorities, but they also must be substantive, meaning that they are effective, they work, and in control. And now, why is this important? As I talked about a few minutes back, many boards adjourn and become boards of these other types of plans that are out there. They are in effect the same board, or they're a subset of the board, or the hosting government or plan performs the administrative duties of a board in the absence of a board. If a voting majority is present, then the next determination involves whether there is a financial benefit or burden or imposition of will between the fiduciary component unit and the reporting government. Under current GAAP, financial burden is present if the employer is legally obligated to contribute to the plan. And it doesn't matter if it's defined benefit or defined contribution, but it appears that the GASB again may amend this to only go defined benefit plans and not defined contribution plans. So here's a common scenario. We have a pension plan, a board with 9 members, 4 of which are elected, 3 of which who are retirees, and 2 who are ex officio. Is it a voting majority? And the answer is 7 members are elected. Therefore, we might not have a component unit unless there is fiscal dependency and financial benefit or burden. So again, understanding the level of majority becomes really important. So what is this thing called imposition of will? This shows operational dependency as well as fiscal dependency. Fiscal dependency is when you make up for deficits and similar. Operational dependency is imposition of will. Most commonly, this is when management of a primary government manages the activities of a component unit in the same manner that the primary government manages its own programs. The fiduciary component unit and primary government are one and the same. They may use the same accounting system, treasury and investment operations, controller operations, or subject to the same policies and procedures. Fiscal dependency does not automatically result in a financial benefit or burden. Fiscal dependency is more in depth. It may include approval of debt issuances, approval of a budget in exchange for funding, approval of tax levies, and so on. And so understanding these differences becomes really important as to whether or not you got a component unit and then a fiduciary component unit. Over these next 2 slides, these show how the differences in financial benefit or burden exists in many different ways. With the most important for fiduciary activities listed on the following slide. Is there mandatory or legal obligations for employer contributions to defined benefit plans? So for those of you who have printed this out, you may want to dog-ear this page for your future use. So the bottom row there, employer contributions to defined benefit plans, is an example of a financial benefit or burden. But in other situations, you could have a fiduciary activity. So for example, if there is a percentage of sales taxation that funds transportation that's passed through to some other government, And if you don't have administrative involvement whatsoever, you're just sort of passing it through, that could potentially be a fiduciary activity. But in some cases, that's not. So what is control? Government controls the assets of the activity. And this occurs when the government holds the assets or can direct the use, exchange, or employment of assets to the specified or intended beneficiaries. Appointing an administrator doesn't really matter. Restricting the assets doesn't really matter. Now, the word use is described as the ability to expend or consume an asset for the benefit of individuals or organizations or other governments outside the government's usual process of providing goods or services to them. So they're beyond the scope of effectively the reporting entity. It's individuals, organizations, or other governments outside the providing of services. A key provision is something many of us also gloss over and forget about. And that exists in footnote 5, and it's discussed in the basis for conclusions to GASB 84, paragraph 11. Footnote 5 says when a government appoints a designee to act on its behalf, the designee is performing the government's fiduciary duties and not assuming them. Therefore, appointing a designee to act on its behalf does not alter the government's ability to direct the use, exchange, or employment of assets. Now, the board added footnote 5 to clarify that if a government appoints a designee to act on its behalf, it still maintains the ability to direct the use, exchange, or employment of the assets. The board also concluded that by eliminating the term to administer, it would clarify that the selection of the investment options or determination of benefits would not by themselves result in a determination of whether or not you have control. And this means that a third-party administrator, such as a bank or an investment house or an insurance company, may be used, but the government still must review the provisions of control to determine whether or not a fiduciary activity is indeed in place. So what we're going to do over the next few slides is put the word control into practice. And here we have a county holding pension assets for other governments in the county, but it's not in trust. And effectively, it's a pool of savings with perhaps even separate accounts within a fund. And each government has its own plan. The county is investing the funds, and therefore the county has control, and the beneficiaries are municipalities that are outside the county's reporting entity. Under GASB 84, this could be a custodial fund because it's not held in trust. And we'll talk about custodial funds in a little bit, but this is just part of the analysis you're going to have to do to implement GASB 84. And if you take a look at the fact pattern here, we are holding funds on behalf of other entities outside, in this case, the county's reporting entity. And as such, we're effectively the administrator. Now, the word administrator is not being used anymore as part of GAAP, so we are a custodian. And we could have multiple answers based on the same fact pattern between governments. Control is more of a spectrum, and not all answers are the same. As an example, a key decision would be if employees can choose investments in a defined contribution plan. And this is one aspect that even I sort of messed up in looking at GASB 84 since its issuance. Because I said, hey, wait a second, if a government, chose the investments and put up a slate of investments that a employee can invest in, then they must be in control, because guess what? You have a contract with a bank or a plan or insurance company, and the government must be in control, but there's varying degrees of that. So a key decision would be if employees can choose investments. If yes, if yes, even if they can choose among three investments and they choose their own investment allocations, the participating employee may be in control. If so, it's not a fiduciary activity. So what does this all mean? It could be that if the participant has control with no mandatory employer contributions, the only reporting may be the payroll withholding and the payables from payroll generating funds. No fiduciary activity. For PERS plans, change would be unlikely as there's no, unless there is absolutely no accountability for defined contribution plans. This is because in many cases, PERS plans operate using Internal Revenue Code Section 115 master trusts. And as such, there's likely accountability for things like 403Bs and teacher retirement systems, and 401As and 457 deferred compensation plans managed within the same administration as traditional defined benefit plans. Okay, so we've beaten the heck out of a lot of pension and defined contribution and OPEB plans. Let's talk about other fiduciary activities. Remember, we're still at control. And if we have control, then the next step would be step one. Are the assets controlled by the government? So we're there. Step two, are the assets from different revenues other than the government's own source revenue? Now, Lee, I have some stuff up here in terms of some examples of own source revenues. And they could be, taxes and fees and fines and other revenues that the governor is parking in a fund that may have been fiduciary under prior GAAP to be spent in a prior year. Under GASB 84, probably unlikely. What are some other ones that we're seeing so far?
I was waiting for you to get to your question. That was quite the lead in. So, some of the things that we've seen in the past that would be, government owned sources. We've seen where they've taken retainers or retainage from construction contracts and have put those into fiduciary funds. Well, in reality, those are government-owned sources, so that would not qualify. Payroll deposits is another one that we've seen that will need to disappear. Sinking funds from bonds would be another government-owned source. Now, some of the not owned sources would be, for example, let's say cash collected from fees that were charged by a not-for-profit cemetery associations, and that the cemetery is managed by the city, but then they receive the fees from the not-for-profit. That would be considered not owned sources because that came from the not-for-profit. Inmate accounts, where we have inmate wages from jobs from being in, in the detentions and the jails. That would be a not owned sources. Students raise money for disaster relief. They've asked the entity to hold and then also disperse based when the students, ask for the disbursement. That would be a not owned source. The county treasurer manages funds for not-for-profit or other entities. Those are not owned sources. Business licensing fees, that would be an owned source. College student activity fee to fund programs, that would be an owned source. What about counties or other organizations that collect property taxes on behalf of other governments and they charge a 1% admin fee? Well, the 1% admin fee would be the own source and the remaining property taxes would be a not owned source. And then one that's proposed in the implementation guide for 2020 is, and GASB was trying to address was, what about assets that are seized by a sheriff or other organizations that gets allocated to the to different governments? that would be considered a not owned sources. So those are some examples that are out there to take into consideration.
Yeah, absolutely. And of course, we could probably brainstorm for another hour as to stuff that could be own source and not own source. I mean, when I was a preparer too many years ago, my legislative body, when they had an embarrassment of riches and had a surplus for the year, used to routinely pass a law that said there shall be a trust. And of course, Eric, being the simple kind of guy that he is, said, okay, gee, I see the word trust, must be a fiduciary activity. And what they used to do is park the surplus in a trust and then for spending in a future year because the legislature wanted to adjourn for the fiscal year and close the books. Well, under GASB 84, that is a classic own source revenue because it's just parking the money into an agency fund, and that's no longer going to be a fiduciary activity. So, Lee and I could go back and forth for hours as to stuff that could be own source, could not be own source. But if it's really the government's own money, it's definitely own source. So that's only the second aspect that's there. The third aspect is you have to have any one of the items on the following slide. And again, any one of these criteria on the left that are here. And so are the assets from some other source than taxes or grants? And again, the assets in this case, if you look at the top left-hand corner, you have the assets administered through a trust agreement where the government itself is not a beneficiary and the assets are dedicated to providing benefits, and you have some legal protection. And you saw that when we talked to, oh gosh, maybe about 30 minutes ago, and that's the classic IDP. And your basic examples are on the right-hand side. Now, one of the problems that we see here is understanding the words in red. The assets benefit individuals, and the government does not have administrative or direct financial involvement with the assets, and they are not derived from providing goods or services for the individuals. We'll talk about administrative involvement and direct financial involvement in a bit. And those are concepts that are hard to understand, yet a lot of us don't realize that they're concepts that have been around since prior to GASB 34. They've been around for about 25 years, and we glossed over them. They were in the old GASB 24 when we were talking about pass-through grants and food stamps. And they're the same exact concept. And again, the assets benefit individuals where there is no administrative or direct financial involvement. In many situations, student activity funds might have administrative involvement or direct financial involvement. We'll go through some student activity funds in a little bit. Finally, the assets are for the benefit of organizations and others outside the reporting entity. And this is what Lee was mentioning about, we're raising funds for disaster relief, not-for-profits. And this one may be common as funds are being raised for, again, not-for-profits, or in the case of municipal aid, passed through from another government without any form of administrative or direct financial involvement. I'm sure folks are watching the weather for folks down south with the tornadoes going through. Some friends of Lee and mine are doing okay, but for the folks who live around Nashville, for example, it looks pretty bad down there. And so I'm sure there's going to be fundraising for disaster relief going on, as well as in other disasters going on all the time throughout the country. So this is where control can get a little dicey. A good example of a government is holding assets for the benefit of other entities, such as other governments. If it is a group of investments like an external investment pool, well, that's a classic fiduciary activity. And it's pretty much what we're doing today prior to implementing GASB 84. But if it was a defined contribution plan and the participants make their own decisions, Well, as I harped on for about, 10, 15 minutes, if not longer, unlikely a fiduciary activity. And the same holds true all the way down the line here. In the case where investments are not held in trust, well, it could be a fiduciary activity, but a custodial fund. The degree of choice is really controversial. What is the level where the participant is in control? Now, if we were talking about an ERISA plan, the Employee Retirement Income Security Act plan, the participant has a choice of if the participant has a choice of three investments, the participant has control, not a fiduciary activity. But those provisions are not in GAAP. We could use the definition of choice versus control, but again, not in GAAP. We're left to professional judgment. And looking down the line here, some of the aspects could be fiduciary if it was an investment management function. But looking over on the right, if it's a defined contribution plan, same fact pattern, might not be in control, might not be a fiduciary activity. So facts and circumstances will change. I mentioned a couple of minutes ago the jargon on administrative involvement and direct financial involvement. And again, those provisions have been in GAAP since the old GASB 24. And they've been replicated 60 standards later in GASB 84. GASB 24 was on pass-through grants like food stamps. And of course, a lot of food stamps these days, they're no longer coupons, they're EBT cards. Administrative involvement is mainly monitoring for compliance, determining eligibility, more than just a rubber stamp, the ability to say no. And of course, administrative involvement rears its head in student activity funds. Can the teacher say, no, you can't use fundraising money to buy beer? That's more than just a rubber stamp. The ability to say no. Direct financial involvement is providing matching or level of effort or being held accountable for disallowed costs. So as you can tell, most grant transactions have some form of administrative involvement or direct financial involvement, as we know and love from the single audit. So now we must think, based on all this stuff, fiduciary activity or not. And in my mind, and certainly I'm sure in Lee's as well, fiduciary activity or not, these are some of the places where major decisions and major adjustments may have to be made. Certainly on the screen, again, if you have this printed out, you may want to circle student activity funds. You may want to circle payroll withholding, and certainly many others. There's going to be some decisions that'll need to be made. So let's talk a little bit about student activity funds. So there are a bunch of implementation guide questions on student activity funds. But we need to be aware, because many state education entities have required filings on student activity funds for compliance purposes. Now, these aspects in the questions may differ. So here we have a chess club in a high school, which is not legally separate, and the club raises funds to pay for student activities. Well, the proceeds are held in the school account. The club is not legally separate, therefore GASB 84 decisions will need to be made. And if there's some form of accountability or decision-making by the teacher or administrator, the school business officer or somebody like that, well, I'm a little closer to a governmental activity than a fiduciary activity. Now, that may mess around with, okay, if it's a governmental activity, perhaps your government has to budget all governmental activities, and you're probably saying, well, wait a second, I don't want to budget for that chess club. Well, it doesn't mean you have to budget for it unless you have some form of law there. And remember, GASB 84 is for financial reporting purposes and not for compliance purposes. And so you need to almost separate the two. So here's another one. Here we have a school district matching funds when a disbursement is approved. Here we have direct financial involvement, and this is really classic governmental fund. You know, when you're putting funds in a matching or level of effort, this is a classic governmental program. Again, student activity fund that would have been reported in an agency fund will now have to be remanded back to a governmental activity. So in this case, yes, you have a direct financial involvement of the school with the clubs because of that matching and level of effort that is being provided. Now here's the other extreme. Here we have students raising funds for disaster relief, not for profit. Let's say the Red Cross or somebody similar, some organization that's similar. The funds are held in a separate bank account and a check is written to the not-for-profit. This is really just a pass-through, and in this case, likely a fiduciary activity. So you can see the extremes. One where we had a matching and level of effort, another where we had a really administrative involvement in disallowing costs, and in here we're just passing through funds. Here we have a touchdown club, which is made up of alumni, parents and supporters. It's not a component unit and the funds are not held by the school. Well, in this case, it's not a fiduciary activity. You don't need to report it. And so a lot of the PTA accounts may be set up similar to this. So think about it when you're dealing with student activity funds. I know a lot of you are out there, a lot of school districts and public colleges and universities that are out there that are on this very wide-ranging webinar. And so you may have to analyze all these activities as to whether or not they're fiduciary activities. I put a bunch of different types of activities that you may need to analyze. For those with printed copies or can write on your screen, circle the first one. That's where a lot of work is going to have to be done. Payroll deductions. It is a huge change. Payroll deduction accounts and similar zero balance accounts, those are not fiduciary. They are activities of the originating fund where the payroll is. So that could be governmental activities, could be business type activities, not a fiduciary. Inmate canteen accounts and seized assets prior to trial. Now, Lee mentioned seized assets by a sheriff. Those are fiduciary because those aren't the government's own source revenue. Those are essentially funds that could in fact be returned to the person who's being charged. These and many more are in the implementation guide. So again, take a look at these when you get a chance. Let's talk a little bit more about custodial funds. They're not agency funds. Do not make the blanket statement that, and a blanket mistake that, hey, we're just going to retitle agency funds and they're now custodial funds. No, no, no. In custodial funds, assets also do not equal liabilities. You will have a real profit and loss statement there, a real statement of changes in fiduciary net position. There are some exceptions to reporting in custodial funds. The exception would be for business type activities where funds are normally held for 3 months or less. In that case, those will just be payables of the operating fund. External portions of investment pools that are not held in trust, also that could be custodial. So for example, let's say you have, again, a government that is essentially managing funds on behalf of other governments outside its reporting entity, but not held in trust. And maybe they're just savings accounts or similar. That's also going to be custodial. If we look at the issues in custodial funds that are there, we have a bunch of issues. And the typical types of funds that are there could have a number of issues. But before we go down the road of whether or not it is custodial, let's just go back one slide here. Let's think about several types of accounts. Intergovernmental accounts for taxes and fees, such as sales and use tax, property tax, motor vehicle privilege taxes. For example, those types of taxes collected by, say, a Department of Taxation or similar on behalf of local governments, that could be a custodial fund. Motor vehicle accounts for taxes and fees collected by the Department of Motor Vehicles, pending distribution to other governments, again, custodial fund. Child support disbursement accounts for centralized collection and disbursement of child support payments. Yeah, those will probably be custodial fund. Payroll accounts for payment of payroll and payroll deductions, such as income tax withholding, insurance deductions, credit union deductions. Nope, not a fiduciary account. So, Lee, what else do you think in a custodial fund?
You know, it could be for a one-time cultural event. I know in our my hometown here in Boise, they've held all kinds of different events celebrating different activities and everything, and the city will go out and will work with other organizations to receive funds, and those other organizations will ask the city to hold that money until the event is over and they paid off all the fees and everything. So that would be from a city perspective. We've kind of touched upon it with the student activities. There could be one-time fundraisers for catastrophes or for certain individuals. So those are kind of a few other examples of activities that would be running through a custodial fund.
Yeah, and but I'm sure those are great, and I'm sure in your mind's eye, the folks in the audience, you're realizing, hey, wait a second, the breadth and depth of stuff that we used to have in the agency funds are going to be nowhere near what we have in custodial funds. And hopefully, in your mind's eye by now, you're realizing you can't just scratch out the word agency and now say custodial. The other ones that I'm seeing in practice are, a lot of governments, especially state governments, for whatever reason, created agency funds meant to be an internal State Department fund to expend a piece of budget or to have a program or service or project that's within a state department. And they said, okay, that's a state agency, must be an agency fund. Well, no, not quite. And you got to meet the definition of a custodial fund that is built into GASB 84. And there are a number of different aspects that are within the implementation guide that you may want to take a look at. That breeds a bunch of problems. So if some of the former agency funds are no longer fiduciary, you have to say, okay, wait a second, what do I do? Well, first and foremost, to implement GASB 84, it's a retroactive restatement for all prior periods presented. And if a restatement is not practicable, meaning that you have to try to do it, the cumulative effect is reported as a restatement of beginning net position or fund balance or fund net position in the earliest period presented. So for the 1231 governments that are out there, you had to do it as of January 1st. For the June 30 governments, you had to do it as of July 1st. And obviously, your fiscal year end and you can do the math. So there are three glaring problems that are here. What's the beginning balance of as GASB 84 is implemented based on the period beginning after December 15 of 2018 or January 1st of 2019? And by the way, if a material amount moves from a governmental fund as a payable, does an opinion unit in major fund change? And it could very well be, especially in very large governments where you have a very large agency fund, which is no longer fiduciary, it's now becoming a governmental activity. And then you have to adjudicate what activities are in agency funds that are purely custodial, and then that remain in those fiduciary activities. And then the third big problem is, gee, we have a pretty good ERP system here. What are my reporting systems changes that I may need to make, or can I somehow adjust it later? Can our reporting systems present a statement of changes in fiduciary net position for these funds, or are they hard coded as agency funds? Can they handle the changes? And in many situations, the answer may be no. Now, I mentioned the payroll withholding a number of times, and again, this one's, I can't emphasize it enough. It's a big deal. That the actual question number may change because of the implementation guide update coming out in a few weeks, but the question itself is not going to change. So this is a big deal. Payroll withholding will no longer be a fiduciary activity, and the amounts must be restated as of the beginning of the period. But what's the number that you're going to use as of the beginning of the period? If the funds are going to go back to a governmental fund where the payroll was generated, remember you have a different measurement focus and basis of accounting. You're going from a full accrual, and yeah, we know that agency funds mainly are cash in, cash out, we know, but you're going from a full accrual to a current financial resources measurement focus and basis of accounting. As such, agency funds were supposed to be full accrual and governmental funds are supposed to be modified accrual. Could some assets and liabilities be removed due to the basis of accounting? Yeah, perhaps. And so this is a real sleeping giant. And I can't emphasize it enough to really think about that almost as among your first decisions. Now that I've gotten that off my chest, how to report fiduciary activities. There are not many changes from current reporting. Additions and deductions can be aggregated by source if they are meaningful. Investment income is presented gross of investment costs. And I was talking with a client about that yesterday as to the elements that are built into investment cost. And they're mainly management fees and so on. Custodial funds can aggregate inflows and outflows if the categories are meaningful. A business type activity that chooses to report resources in its own statement of net position instead of an agency, see, I'm almost messed up. Instead of a custodial fund should separately report additions and deductions if significant, as cash inflows and cash outflows in the operating activities category in the statement of cash flows as well. So if you happen to have a business type activity where you think you happen to have a custodial fund activity, as long as it's 90 days or less or 3 months or less, you know, you can report it as part of one fund. Now, what about the liabilities? In the statement of fiduciary net position, there may be some minor adjustment, as the updated guidance is based on presentment for payment. What do you think the examples are, Lee? You know, any others beyond here?
Well, since it seems to be a pretty hot topic, we'll continue with student activity funds. Whereas before you just had cash and due to the student activities, now if there's been an invoice submitted for payment before year end that's not paid, that needs to be separated out. Now, I have seen some of my clients that have kind of been ahead of the game and have been doing that, where if they know if the invoice has been submitted, that they'll show that as a payable, and then the rest of due to student activities. But that'll be one that'll be that everyone's going to have to address from that perspective. And I think another one, and it won't affect a whole lot of people, but it's a good example, is a college tuition reimbursement for a prepaid tuition plan, 529 plan. And so in a prepaid plan, it's a benefit that's already been determined. And when the student or the parents of the student goes to request for reimbursement for the room and board or whatever is allowed under the program, that will now need to be recognized as its own payable line item as well. So those are a couple typical but a unique one as well when it comes to recognizing the accounts payable.
Yeah, I mean, I think those are going to be classic ones. You mentioned a cutoff, in declaring a payable. That was pretty much the way this particular client does things when they get close to the end of a fiscal year, and they have an investment fund that manages funds on behalf of other entities within their jurisdiction that are outside the reporting entity. They have sort of a cutoff a couple of days beforehand, and anything that comes in before the end of the fiscal year, and anything that comes in before the end of the fiscal year, they declare that as a payable because that compels, in this case, the investment fund to disperse the resources. And so, that's pretty much GASB 84, preparation of a statement of fiduciary net position. I think they're pretty much in compliant, but we did talk about, like I mentioned, in the P&L side, the calculation of investment cost and so on. So let's take a look at the statement of fiduciary. Thank you, Lee. Let's take a look at the statement of fiduciary net position and statement of changes in fiduciary net position. As you can see on this screen, and this is a slide actually from GASB, if you take a look over at the right-hand side, that's where your custodial funds will be. And I have gotten questions over recent weeks. Gee, should our supplementary information or combining statements look like this? And absolutely they should. And so you'd have a combining statement of all your different pension and other employee benefit trust funds. If you have multiple investment trust funds, you'd have a combining statement for that, and so on going down the line. And if you have a bunch of custodial funds, yes, you can have a combining statement. Those are supplementary information. They are not required by GASB. However, if you prepare a CAFR, you would have a combining statement for custodial funds that are out there. So here is the statement of changes in fiduciary net position. And if you look down in the middle of the screen, and I don't know if you can see my mouse. Let me see if this thing works here. Yeah, let's see. Let's pull this up. Right over here. Magic. Here we have one line that says sales tax collections for other governments. You can aggregate in custodial funds as long as the titles are meaningful. And again, payments of sales tax to other governments. Now, if you have multiple types of taxes that are being collected and then remitted to other governments, which would be a classic pass-through that is within custodial funds, it's up to you as to whether or not you disaggregate that. The titles need to be meaningful. Now also look up here where it says investment costs. The titles are changing. It starts off with total investment earnings, and I know I scratched through that. Less investment costs, and notice the securities lending costs are in there as well. For the various types of investment-oriented funds like pension and OPEB funds, investment trusts, and private purpose trusts, this section will need to be changed slightly, and it's a little bit more than just the titling. So you need to take a look at the definitions of what are investment activity costs. In the immortal words of Steve Jobs, but there's more. The GASB is proposing some additional questions for the 2020 implementation guide. As Lee mentioned, we're going to have an implementation guide coming out probably in about the next 4 to 6 weeks or so, probably April timeframe. Will these change prior to publication after the discussion in 48 hours? Well, we'll see. There are 3 new questions related to fiduciary activities and 5 amended questions that mainly relate to pensions and similar activities. On these 2 slides, there are 3 proposed questions. The first one is one that Lee mentioned, and this is one that was supposed to be in the implementation guide update last year. It was delayed because there was a fact pattern change they needed to do, and the staff were told by the board to go back and get some more information. And sure enough, it's going to be resurrected, I think, without change in the implementation guide update for 2020. This is one I would focus on the sheriff season cash, because nearly every general purpose government that I've dealt with as an auditor has some form of public safety function of which they do seize assets from time to time. We've been talking about this one to clients for a few months, and certainly it could be a big deal. Assuming the government has seized control of the property could be a custodial fund. We've been suggesting to clients some procedures on inventorying these funds if they are material, and certainly if you're seizing things like drugs or houses or cars or things like that, they could be very well material. Here's a couple of other proposed questions, again on student activity funds. The main aspect of question 4.5 and 4.6 was to emphasize the difference between administrative involvement. Notice in 4.6 is that the resources can only be spent on class activities that benefit that particular class. And in that case, there is some form of administrative involvement because administration has to decide whether or not that particular class is being benefited. Again, this is just proposed. Now, implementing GASB 84. As you can probably tell by the amount of time we've been spending over this webinar and in other webinars, this is not going to be easy. You're going to need to gather the information, including your laws, regulations, trust agreements, and so on that support your decisions. And compare the proposed decisions back to GASB 84 and then document your decision. Again, don't look at your peer government. Differing facts and circumstances could result in differing decisions. So if your next door school district, it says a student activity fund is a fiduciary activity, don't automatically say your student activity fund is a fiduciary activity. Again, everyone could be different. Again, also make sure you understand that these defined contribution arrangements, they could change. So keep a watch of our website, keep a watch of the GASB's website, and we'll let you know as soon as we know as well. How to document your decisions. I happen to like just creating a simple spreadsheet or a database, say with about 8 or 10 fields, including sign-offs. And don't forget bank accounts and dates of contracts and so on that are here. Component unit decisions, administrative or direct financial involvements, lists of beneficiaries, and other items. Document your decision that you make and have senior management review and agree to it. And the fields you may want to address are on this slide, at least at the very least. And take a look at each one of these bullets, and that's where I would start. Let's apply what we did on the previous slide. So we're going to take these criteria and apply it to a fact pattern. Here we have a school district with a chess club, fundraising activities to fund the chess club activities. There are activities that are being led by student leaders. A teacher gives oversight, as we don't want to have kids spending on things that are improper. There are policies and procedures at the district, but no further school board approval. A school business official invests the funds overnight per school policy, but funds are not held in trust. So what do we have? Well, here is a typical spreadsheet that I happen to put on a slide. Here we have the chess club over on the right-hand side. Here, is it a component unit? No, it's the chess club. Is the activity controlled by the school district? Well, yeah, it's in a bank account. Determination that the assets are not from our own source revenue. Yes, they're not derived from our own source revenue. It's not the school district's money. Are the assets held in trust for pensions or OPEB? No, it's the chess club. Are the assets for the benefit of individuals and the government does not have administrative or direct financial involvement in not providing goods or services? Well, yeah, that's looking pretty good. The assets are for the benefit of other governments outside and not derived from providing goods or services to those organizations? Well, no. Our conclusion here was fiduciary. And here we're having Jane Smith prepared it and Martha Jones signed off on it. So this would be classic. And obviously the facts and circumstances are going to change for your own individual situation, and you're going to have to figure it out. But this would be a way to document things. So with that, we have just a few minutes left. Your questions. Let's see what we have here. Here we have one. Can you address fiduciary reporting of 529 plans, not specifically, not the prepaid plan, specifically if a state matches contributions using state appropriations, it appears that those funds would not be reported in a fiduciary fund. Can you provide guidance? 529 plans are interesting. That's probably, that's going to be a state decision. That's going to have to be made. I mean, Lee, what do you think on that one?
I'm sorry about that. No, I would agree with your answer on that one.
Yeah, I mean, if you got some form of matching, it seems to be, it seems to be that you're probably going to have some form of governmental activity, that's dependent on appropriation. I'm not sure that's a fiduciary activity anymore. Could be a business type activity as well. Could very well be. College foundations. Somebody asked about college foundations. Well, I'm assuming those are legally separate, right? And the ones in practice, Lee, most of the ones you've seen are legally separate, right?
Yes. I think the thing is what, getting questions and over the past few weeks about, is GASB 84 actually bringing on a whole new way of determining component units? And it's not. Component units, like you mentioned before, is already under the standards of 143961 and wherever, and a couple other places. All GASB 84 is going to do is going to help you determine, well, is it a fiduciary activity or not after you've decided if it's a component unit. So when it comes to college foundations, I mean, if you've already determined that it's a component unit, now that next step, which may change, but I'm thinking that it may not. For most of them, they will not be reported as a fiduciary activities, but you'll have to take a close look at it.
Yeah, I mean, if you haven't been reporting it as a component unit before, you may want to, kick the tires on what were the decisions made that did not make it a component unit, because per se, the component unit aspects really didn't change. And so just be careful of that particular one, kick the tires on whether or not you got a component unit relationship to begin with. And remember, if you were supposed to report a component unit and you didn't before, you got a beginning balance adjustment because you got to change your reporting entity. What if you have a irrevocable trust set up for employer pension contributions? The payments go to the statewide pension plan, not to the employees' retirees. Would those fall under GASB 84 trust? Well, how do they not go to the employees eventually? If it's like a rate, what do you think on that? Is that like a rate reduction fund, Lee, or something similar?
Yeah, I'm struggling with this one as well, because I know at one point in time when the 67 and 68 came out, and when if you had two different trusts, there was that issue to try to determine should those continue to be shown as a pension trust. And I think some of those plans, because they weren't an irrevocable trust, they went back to the general fund. But I don't think we've addressed it from here. So I guess the short answer is I don't know, and to be something I have to check into and get back.
Yeah, and certainly whoever asked that question, if you want to email Lee and myself, on that one, we're going to have to do some research. And this one might be, it depends. Certainly, in my mind, if the funds revert back to the government to be used to buy down the rate of contributions in the future, and if it's held in trust by the employer government, rather than the plan itself, it'd be hard to be a fiduciary activity, but I'm not sure. And I apologize for not being definitive, but that's the problem with GASB 84. Is the definition of a component unit, is the definition
Eric,
of, yeah.
we've already answered that one. You can go on to the next one.
Oh, excellent. See, let's go down a few of them. Can you provide an example of a non-PEB component unit that would be reported as a fiduciary? What type of fiduciary would that be? Oh, that's a good one. Let's say, well, a classic example in my mind would be an external investment trust, like your county investment pool that is managing funds on behalf of other entities within the county that are beyond the reporting entity, municipalities and so on. Another one would be, say, a cemetery trust. And the cemetery, for whatever reason, just happens to be a component unit. And in that case, that's probably a fiduciary. I mean, I don't know of any other ones. What do you think, Lee?
No, I'm just going to go with what you said. Yeah, those are good examples.
Yeah, and again, the big dollars are probably going to be in county or statewide investment pools. Another one, and we're running out of time here, and I'll just do one more. The payroll withholding fund processes payroll on behalf of all funds. Would that be reported as an internal service fund or allocated to governmental activities? And where would the payroll withholding be reported? Well, sure, you can use an internal service fund, but your basis of allocation might be a little off, because remember, internal service funds, you have to close them down effectively every year. You have to close. Oh, I know we're running out of time. You have to close them down as part of the closing process, and so you may want to remand the payables back to governmental activities, business type activities. What do you think, Lee, on that one?
Yeah, I mean, you can show them all there, or you could even, some entities are considering, well, they just go ahead and report everything in eventually it gets to the general fund, at least for, year-end reporting purposes with the liabilities, because the general fund's going to be paying that. So I think a lot has to do with, how you're set up, what's the best way of doing the transactions without spending a whole lot of time and everything. But yeah, I would agree with you. Internal service fund probably isn't the best route. I know from easeability that, you set up that separate fund so you can just put it all in the one and do it, but you could do that in the governmental and a general fund as well.
Correct. Correct. So yeah, I'd probably recommend, wherever the payroll was actually generated. So with that, we are running short of time. I do want to thank you, and thank you for spending your midday with me and Lee. And certainly, if you want to reach out to me, there's my email on the screen. If you want to reach out to Lee, his is lmiller, MILLER, at iBailey.